Good morning to the Investor Master Series. My name is James Boyd. Welcome all of you here this morning on this Tuesday morning. Sharon, good morning to you. Eva, good morning to you. Amanda, Orlando, I think you're playing on the Australian Open right now. You're taking a break from that maybe the five-setter you might be playing today. Orlando, good luck to you. And also Gary and many others. Orlando, you should be down there. We'd like to welcome also in the chat. Take a look at here just a moment, and we welcome. So I'll be watching actually the chats as well. And so if you have questions as we go, just let us know. Now, this class, Investor Master Series, we talk about stocks. We talk about maybe macro data that could be affecting the markets in general. Okay, I'll show that here today. We'll talk about maybe some stocks in terms of the fundamentals of the companies. We'll take a look at them in terms of technicals and also options. Our goal, and also even bring up intermarket analysis. How do things correlate between different asset classes? And I think that when you start to kind of see that bigger picture, you can kind of start to have more confidence in some of the trends that we're seeing and why things move like they do or could. Now, just real quick as we get started, remember that options carry a high level of risk, not suitable for all investors. All of our trades will not be options. Some of them are just going to be stock examples. Some might be stocks complemented potentially with the use of options. Remember, the information here is provided for general informational purposes only. Also, this webcast does not recommend technical analysis only. We'll talk about some fundamentals as well. And also remember that all investing involves risk, including loss of principal. And also when we talk about examples, they are just that. Now, first off, I want to kind of go into when we talk about assess market conditions. Let's go to that first, and I just want to kind of go over something that we saw, and I want to bring this up, okay? So right on my X page, I'm going to kind of go, and I want to bring up some of the something that I posted yesterday, okay? So if I kind of go down here, let's get to this page. Sorry, there it is, okay? So let's bring this up. So this is going to be the Schwab Market Update Week. Try to magnify it for just a second, and Gabe might help me with kind of zooming in on this. Something that I want to kind of point out here, okay? So this morning's JOLTS, the job openings, they were expected to have 7.74. They got 8.09 million job openings, okay? So higher than expected. Now, is that good or bad? I mean, having more job openings, is that good or bad? Second thing we actually saw here today, ISM services number. They were expecting a 53.3. They actually got a 54, okay? So 50 is kind of the cutoff point where you actually say 50 and above would be expansion, and below 50 would be like contraction, meaning the economy is slowing a little bit. So you got both macro numbers here today better than expected. Now, notice what we actually have coming up, which we want to be aware of, okay? We have the FOMC minutes, and those minutes are coming up tomorrow at 2 p.m. Eastern time. And they give some updates in terms of what they expect the interest rate to be, okay? And maybe the policy going forward and any of the colorful language around that. Now, also going up on Friday, we got also the non-farm payrolls, okay? So really the first full week of the month, you get some economic data coming out. We get the report card of the economy, okay? Now, I want to kind of just real quick go to kind of what we're seeing in the marketplace. And I'll come back to NVIDIA in just a sec. But if you look at the SPX with kind of some of the economic data we saw it kind of volatile for the market. Now, if I said to you such as the market is getting crushed, okay, now that seems a little extreme, okay? And we're down 20 points. We're down 20 points on an index at 59.55, okay? Now, on a percentage basis, you're literally at you're down 0.3%. Let's get a hold of ourselves now, okay? Grab yourself and say, get a hold of yourself. Now, if we also went and looked at the price and said, did we fall down below the moving average? No. What do you think is going to be the potential support? Maybe the moving average. It went down intraday on some of those economic numbers, trying to get a little bounce here. So I can't really say it's something. If we have some of this economic data, we got the FOMC tomorrow, jobs numbers on Friday, what do you think is going to happen? It's probably going to be more volatile. It's It's not a surprise. Okay. So it's about kind of what you would expect. Okay. Now, also, if you take a look at the NASDAQ, we have the CES going on right now. There's been some kind of demonstrations of some of the new products coming out in the tech space. And you're going to see that the NASDAQ went right down to the 20-period moving average, trying to get a little bounce, but definitely a little bit more down. Now, I'll come back. I'll bring that up right now. With the rates that we're seeing, interest rates, okay, and the interest rates affects, okay, let me kind of move this down for just a sec, okay? So why do the interest rates matter? Why do they matter? Well, because companies borrow money. Well, if they borrow money and the rate is higher, well, it could affect the profitability. Why does that matter? Well, the profitability affects earnings per share, okay? The problem with also higher rates for longer potentially is as you look to do many projects, some of those returns of what you think you could make given a higher interest rate might not be a profitable project. It's like you buying a piece of real estate and saying, the interest rate's 10%. Would this make sense for us to buy this piece of property, whatever it is? The higher the rate goes, the less projects make sense for the company. So this is kind of becoming a little bit more of a headwind for these companies. Borrowing costs becoming higher, okay? And you're going to see that if we look at the 10-year yield, now, by the way, good thing we taught you last year on futures, not a recommendation, about rates, because those rates have been moving lately. And you're going to see the intraday went down to the 10-period moving average, doink, back to the upside here. Now, what's the relationship between the 10-year and the U.S. dollar? Well, let's take a quick peek. U.S. dollar, after selling off a little bit yesterday, trying to bounce back here today. Overlay the 10-year. Overlay that with the U.S. dollar itself, DXY, and you'll see that there's a pretty good correlation there. So if you think the economy is going to be stronger, rates rise, well, the investor might say, I'm going to be long or bullish more the U.S. dollar. You're really picking a currency which is backed by really an economy that you actually think might do better than other economies in the world, okay? It's almost, when I say like you think a country is going to do better, we could also say a company is going to do better, okay? The U.S. company compared to Australia, compared to Canada, compared to Europe, and so on. So you're picking a country that you think on a economic stance could do better. And how do you know if it's doing better? Well, manufacturing, GDP, and so on. So these things kind of matter in the bigger scheme of things. It's not all about bull flags. Let's just be honest here. And that's why I want to kind of take some time to go over that. And I know some of you technicians just got your feelings hurt, but don't worry. We'll hug each other in the end, okay? Promise. I'm coming. Now, if we take a look at this, SPX. So I can't say anything changed since yesterday, okay? Kind of just looks like we're absorbing some economic data. When you look at, let's say, the Dow Jones, a little bullish, okay? Maybe a little bit better. We said that one was lagging. And the Russell, any change from there, from day to day? Not much. We did see it fall down below the 10, bounce back up. Not a reversal yet on the small caps, sitting here at 2280 or so. We did also see, for example, some activity, pretty strong activity in the semiconductor, the SOX. Now, I want to ask you a question. Is it bullish or bearish? Now, we know that NVIDIA, the CEO, was doing some demonstrations this morning from what I saw on X. And you're going to see that, sometimes when there's an event, sometimes traders trade around that event. They buy the speculation, they sell the news. We'll go to NVIDIA in just a second. But if we take a look at this, you might really be looking at, let's say, the SOX and saying to yourself, well, geez, we're up near this area of resistance. Yesterday might have been something like a little fade, but today we kind of fell down and we're pushing up again. Not closing near the low so far if we closed here, but we're kind of right at where we closed yesterday. But the thing is, we're kind of holding up near that area of resistance. The stock that, for example, is probably holding up a little bit better, which I'm going to start with. I want to start with Micron, and I want to start with just real quick NVIDIA. Now, we did a trade on NVIDIA yesterday. I'm coming back, okay? And I want to kind of take a look at this for just a sec as this kind of snapped back inside this old channel. Now, in our world, okay, let me kind of bring up, it's so dangerous. I don't, I don't trust Microsoft Word. Okay, so let's not go there. Let me draw it. I just don't want to, I don't trust what's, yeah, we'll leave it at that. So if we, for example, have a delta of 0, okay, what would be like a delta of 0? Think an iron condor, right? If I said, for example, hey, we're going to pick a stock position. Well, you can think of that stock position as like having a delta of 1. So if we buy 1 share, stock goes up $1. The return should be, unrealized return, is $1. It's dollar for dollar. Well, if we kind of said, James, the market's kind of volatile right now. Well, this is why there's different strategies. Thank heavens, okay? Now, if I said, look, I want to kind of play something that might only be moving like 1/10 of a point. Well, that would be like a vertical, long call vertical, short put vertical, okay? Now, a little bit bigger than that, we might say, hey, if we said, hey, pick a 30 delta, 0.30, that could be like a cash secured put. I'm also going to include in this a caller. Now, James, why are you so fanatical about this caller? Well, we reset the portfolios 2 weeks ago, okay? And so we're trying to get some stock positions. So the caller is a stock, buying a stock, selling a call, and buying a put. But it has a delta like a cash secured put or a short put, SP, okay? Now, the difference between those two is caller has the shares. The short put does not have the shares, keyword is yet. It has the obligation to buy the shares, okay? But it doesn't own them yet, okay? So we're sold something and we have the potential obligation to buy the shares at the strike price from the time we sell the put until expiration. Now, what I want to do in this case is I want to go back and I want to kind of use this Micron as an example of selling a put. Now, selling a put is a foundational concept for these two portfolios because we're trying to find stocks that the investor thinks could be bullish and they might try to buy at a potential discount from where it is now. Now, that doesn't mean there's no risk, okay? But the investor is selling the put where they think the stock could be or where it could close above that. Now, there's two sides of this. Do you sell a strike close to the current price? And if you do, you're saying two things. Number one, I think the stock could be more bullish. And two, you don't mind in maybe being assigned or buying the shares of the stock at pretty much where the stock is now. If you say, well, no, I don't want to sell like a 105 strike. I was kind of thinking about selling like a 100 strike. Well, there it kind of might more lean towards income, potential income, getting the credit, and having a lesser chance of owning the shares of stock. Now, that doesn't mean there's no probability of owning the stock. You have a pending obligation. So I want to kind of come back to this. I want to sell a put or some putties, as my friend would call it. Okay? Now, what we're going to do is going to go to the IRA account. Now, what I want to do in this case is I want to go back to just real quick the MU, okay? And here's what I want to also be mindful of, okay? When someone's establishing a portfolio, one of the dangers with options is you put all the expirations, you put all your trades that have the same expirations. Okay, that maybe is not a great idea because wonder if in the next 10 days the market is bearish and you did all bullish trades. So we did one or two of these monthly options with only 10 days left. I'm saying now, okay? But I'm going to go now down to the Februaries. Now, we know if we go to the Februaries and there is more time, then the premiums should be probably higher. Why? Because there's more time. Now, notice that the implied volatility is higher, okay? You might have earnings in this time frame right here. That's why it's higher. And then when we look down the table, it's a little less, probably because we get past earnings. Now, what I'm going to do in this case is I want to go now to just bring up for just a moment, okay? I'm going to bring up the delta. Let me put that on for just a moment. Put on the volume, okay? and then we're going to put on the open interest. So trade number one here is we're going to try to sell a put where we think the stock could stay above the strike price. Now, the dangerous part about this is if you sell the put, let me click on this. We're in the IRA account. Click on it. What you're now going to notice is if I go and say confirm and send just to show you these numbers real quick, they're going to say the max loss is 9,600. So they're saying, hey, you could be assigned the shares to buy at 100, less the premium, 375. You get 96.25 break even at expiration, not today. Okay. Now that does not include the commission. Okay. Cost of the trade, including commission, just reading the word. Now, one of the risks we talked about that we're going to do now is we're not just going to sell the put only. We're going to buy a put out of the money. And we've been very consistent, looking to buy a put out of the money with a delta of 10 or less, maybe the 85, maybe the 80. And the answer is we can do each one of these. The advantage of this one is smaller max loss. However, bigger debit. Okay, we did this one, smaller debit, but bigger max loss, and so on. So what I'm going to do is we're going to sell the 100, buy the 80. Now, this is your classic short put vertical, but the biggest thing is really about this is it has some downside protection. Now, what you're going to notice is when we sold the 100, the credit was 385. But wait, why is the credit now 358? Well, because that protection or the right to sell ain't free, and you're going to see that the credit is a little less. You will also notice that when we go to confirm and send, there is an extra 65 cents for buying the put. However, instead of having the max loss of $9,000 plus, it's a max loss of $1,640. Okay. Now, so trade number one that we're going to do in this case is we're going to do and by the way, what I call this a vertical, it's technically a vertical. Short, wide put vertical. But you can also think of this as a cash secured put with downside protection. And what is the protection? Well, the right to sell the shares at 80 if the investor was assigned, especially. We're going to go ahead and send that order, and there you go. Now, are there any questions on that? Are there any questions? Now, Carol says, beware, okay? Inauguration day. Okay, so by the way, is that something that can make people jittery? Maybe. Okay. Now I want to go back to something just real quick. And so trade number one was Micron, and it was done in the IRA account. Now I want to go back to NVIDIA for just a second here. Now this morning, from what I saw on X, we had the CEO, I think it was maybe even yesterday, but also maybe this morning, checking on that. They had some news come out about kind of where the AI was going and so on. And there was some serious activity here, okay, on NVIDIA. Now, when we go to the trade tab, when we saw this trade yesterday, it was like it traded 160 million shares at like with 2 or 3 hours to go in the marketplace. We've already traded 185 million shares in like less than the first 2 hours of the market day. Now, the position, we did an example of a shorter dated option, sold the 149, and we're literally at the 145. And remember, the 145 is the long put. That's the right to sell the shares at that strike price, okay? Now, the 149 is really the bullish position. Thought the stock could stay above that. Now, you're going to see that today, on that vacillation in price, the position is down $385. Let me speak to this for just a moment, okay? Now, if we looked at this position and said we're down $385, and we had a portfolio at $105,000, if someone said, hey, we are getting absolutely hammered, be very careful listening to that, okay? Be very careful. So first off, we got to put it in context, okay? So if we're down $385 and we had a portfolio of $105,000, $385 on $105,000, okay? We are down 0.01 would be 1%, okay? We are down 0.3%. Now, if someone called you up and said, my gosh, Paul, my gosh, Carol, my gosh, Eva, absolutely got killed in this one position. I lost 0.3%. They would be like, are you serious? Okay. So be very careful in saying stuff like that. I see it a lot of times on people saying stuff. This is what we call the acceptable risk. We were willing to risk 0.75%. So far, we're down about 40% of that. Okay. Now remember, when we talk about max loss, what are you willing to lose? What are you willing to risk? Without willing to risk something, what do you potentially make? Okay. And the answer is nothing. Okay. So in the world we're dealing with is we're saying, hey, what am I willing to risk? Now, sometimes we have that kind of buy the rumor, sell the news. Okay. Now, sometimes this might kind of be for some maybe an opportunity. If they're trying to get long, they might say, hey, look, I know today we kind of had a news event. I might want to, for example, try to get in on that volatility. I'm going to overlay on top. Okay. Let me go back and do this. Remember we talked about yesterday? The position sizing, right? On the margin account at 30,000, we said we're willing to risk 1%. Okay. That 1% was $300. On the IRA, 105,000, 0.75 to 1%, it was $787. I'm not going to freak out if we're down $300. Okay. Now, what I'm going to do is I'm going to go look at this right now and say, what do we got right now? We're at 104,000, about 200. So I'll update that. So when you think about the acceptable risk, it's really like saying, how many times could you take that acceptable loss and be okay with it? And I'm going to be honest with you. Myself and a lot of us kind of have to get used to that of how many times could you lose that and be okay without it fracturing your confidence. So what we're going to do is we push down the balance a little bit, 104,200, which we can see about right there. Still risking the same percentage, but the loss is going to be just a couple dollars lower. We're going to come right back in, okay? And what I'm going to do is going to try to take advantage of maybe some of that volatility of price. And we're going to come right back down to, let's say, that lower end of that 30 to 40 delta again. Now, when you take a look at the volume here, and we talked about that yesterday, the volume is still pretty solid, okay? Obviously, on the shares, it's been pretty high. But I'm going to come down here to maybe something like a delta 30 to 40 and try to sell just one put. Okay, so we're selling in this case the February 21, the 133 strike, and I'm going to buy a put out of the money. Okay, so we're selling the 133 that has about a 30 delta, going to then buy a put out of the money. Okay, now remember when we sell the put, now where's the 133 on the price graph? 133 is about right there. So wherever we sell the put, that's where we're thinking we don't mind to own the shares. Usually where we say that comment, that's probably in the area, vicinity of support. All right. Now, we could say all that, but if the stock starts coming down, all of a sudden we have second thoughts. Okay. And that's why you got to be comfortable about the position size, the obligation or the right, and what is that potential max loss. Now, what we're going to do in this case is we're going to buy the put. Where is a delta 10 or less, 116 or lower. And even if I just pick something like the 115, okay? Now, there is a built-in maximum loss with this. And you're going to see that the way you get the maximum loss is the stock would have to close below both strike prices. Now, could that happen? It could. Might be a pretty rare example, but it could, okay? We're going to sell the 133, buy the 115, confirm send, note the credit, less the commission. There's the break even today. That's not true. It's break even expiration. Okay. Send the order. Now, when we do this position, let's be aware of what kind of the Greeks are telling us. Delta of 38. So if the stock goes up $1, unrealized gain, about $38. Theta overall in this position is negative theta on that position. Okay, but we have not gotten filled on the ones we just put in now. Okay, now the question is, hey, If the stock goes below the short strike, does that mean that the short put is assigned automatically? What's the answer to that question? No. Okay. Whoever bought the put has the right to sell the shares at 149. This paper money account has the obligation to buy. We do not control the exercise. The buyer does. Okay? The buyer might just have the 149 put as protection. Okay? And it's up to them to decide when they're going to exercise. Now, if they don't exercise and sell the shares at 149, they sell them, we buy them in the paper money account. The only other thing that could happen is if the stock were to close below the 149, anything with intrinsic value, meaning stock is below that strike price, anything with intrinsic value could and should be exercised automatically, or could be exercised, could or should, by the broker. Okay? So if that stock closes below the 149 at expiration, that three contracts morphs into now 100 shares of stock each for every contract we have. So if we had 3 contracts, we would have 300 shares. Now, can this portfolio buy 300 shares? Well, it could. I'm not really sure if that's really the goal of what we're doing, though. Now, the Degum stock has moved on us a little bit, so I'm going to go back into the order, right-click, cancel, replace the order. Going to come right back in. It's moved on us about 9 cents or so. I'm going to click the unlock right there. Confirm send, move the price down about 7 cents. Just because I moved the order there doesn't mean it's going to fill. That one took. However, when you take a look at that, and let's just verify, that was for 1 contract. Now, why is this one 3 contracts? Well, that's more your classic vertical. And this one right there, that's really more of your cash secured pet. Now, question is, how does gamma affect this? Well, when you take a look at a vertical, gamma it doesn't affect the position as much because you bought and sold strikes that are closer together. However, if you pick something like this where the strikes are wider apart, gamma now plays a bigger part. So think of delta as the first dollar move. Okay? Think about gamma as the second dollar move. Okay? And so gamma is the change of the delta when the stock goes up or down $1. Okay? Think of it like that. All right. Now, let's go back to kind of another area that I want to kind of take a peek at. Okay? So one of the other stocks, and I want to kind of bring up, if we could, let's bring up Visa for just a moment. One of the stocks, so now 2 weeks ago, when we started this portfolio again, we picked a ticker V. And we said that V was breaking out. Now, if I look back on this position and I said, was V breaking out at that time? Now, remember, we are trying to establish a brand new position. And this is what the position looked like. Or I should say the chart. And I would look back and say it was a breakout. Okay? And that's the entry that we took. And the trade on that was as follows. Bought the 320 call, which is a bullish position. You buy the calls, you have the right to buy the shares at the strike price. You control the exercise. What does that even mean? Exercise. Well, it's the right to buy the shares at the strike price. Okay? So a long call gives you the right to buy the shares at the strike price. You go from an option position to long shares of stock, or you buy the shares of stock, and that term is called exercising. You exercise your right to buy the shares. All right. Now, if we take a look at this, we also sold the 325 call. And what you're now going to notice is we're down 329. We have 10 days remaining. Now, if we looked at this position and said, well, how bad is this? Well, you got a $5 wide spread. And if you look at the debit there, it looks like it was $2.60. Okay? Look at the difference. You paid this $6.30, you collected $3.70, $2.60 debit. Now, you got 2 contracts. So what is the max loss on this position? Okay? $520. Now, if this portfolio started off with $105,000, if I say something like, oh man, this one just literally hammered this portfolio. We're going to stop saying words like that because I don't know how helpful that is, because when you put it on a percentage, which is what I'm teaching you, it's literally a half of 1%. 0.01 would be 1%. 0.0049 is a half 1%. So if we lose the full $520, we would lose a half of 1%. That literally going to break my confidence or yours? Maybe not. Okay. Where are we now? Well, we're down 329 of the 520. Now, this is why having some time is pretty important here. Okay. We're down 329 of the 520. So we're down 63% of the max loss. The problem with doing short-term trades is you might not have enough time to, if they can reverse or they could reverse. We're kind of now in a situation of like, how much more time do we have to see if it can't bounce itself back to the upside? Now, if I look and saw where we were now and said, man, is it so much lower? Not really. Kind of just looks like, I mean, from where this was, let's take it there to there. The stock is down maybe $5 or so ish, down 1.58%. Okay. But when you have two contracts of it and it's a $300 stock, it's down a little bit. Okay. We went over the numbers. So this one probably by next week, we need to kind of see if we can't get near where this was. But overall, when we say, did the trend break down? And I need a definitive answer. Don't give me this mumbo jumbo, kind of, it depends, okay? Well, if we look at this, all it looks like it kind of did is it fell down to the bottom end of the channel, okay? And if we look at that diagonal support or maybe horizontal, it doesn't look like it broke support, but it definitely did fade back. And now this is kind of why we kind of said, when the moving averages are red, there tends to be more pain than pleasure. Now, if you like pleasure, you're trying to actually have those moving averages to be green, okay? Now, the trade was put on when the moving averages were green, but the stock has pulled back some. Now, on the verticals, we're trying to hold it down to 4 to 10 days before expiration and then make a decision to exit the position. The goal is not to hold down to the expiration, because now that can have some certain things occur, okay? Now, the comment is, Rick says, does not look like a rebound in time, cut the losses. That's an option here, but I think we probably could have, okay? We're going to give it maybe to the end of the week or to next Tuesday to see if it can bounce. Now, I'm going to kind of play Rick's game here, okay? If I said, I'm with Rick, okay, and I don't like the trend here, and I want to kind of say that if we get below 311.80 or so, I just want to get out of the position. I'm willing to cut the losses and try to avoid the max loss. So all I'm going to do is going to come back into the trade tab, and I'm going to right click on these lines. So you can highlight both of these lines by holding the shift key down. All right, that's not bad. Then right click, okay, create closing order, sell. So let's kind of go with Rick a little bit. Rick's a smart guy, right, Rick? Now what I'm going to do is create closing order. Now, Rick, you can say something back, and it's not prideful, okay? We know you're a smart guy. Create closing order, sell. Now, what I'm going to do is, if I'm not going to do it off the option price, I'm going to do it based off the stock price. Limit, market, dated GTC. Okay, there it is. Now, what I'm going to do is, I'm going to do this order condition, this exit on this vertical with time running out. I'm going to say, look, if Visa gets lower or equal to, let's say, 311.50, exit those options at their market prices. And there's Rick, okay, with a smiley face. Rick thought he could trick us. He ain't going to trick us, okay? We know you are. Now, here it is. So if Visa gets at or below, now, why the 311.50? Well, that 311.80-ish was that diagonal support. The last 3 days, okay, we've been kind of hammering right off that level. See that little touch right there? See that little touch right there? See that little touch right there? If we go down below those three lows, that's not a great sign, and we're running out of time. So the investor is saying, I'm willing to accept a partial loss, partial max loss, and try to avoid taking a full loss. So this is kind of almost like trading a vertical and setting a conditional order. And that is a correct statement. Now, do you have any other questions there? All right. Now, what I want to do is I want to also kind of go back to some of the others that we're seeing here. So one of the other stocks that's getting a little bit of a bounce here is IBM. Okay. Now, IBM, we're talking about it's a $225 stock. Okay. Now, IBM kind of has, if we kind of were to draw this, some angles of resistance, maybe there. I think if we drew it a little lower, I don't know if at the end point it's going to be any different. It might be there, okay? So you can go from a farther back spot or maybe a lower spot, but at the end of the day, we're kind of getting exactly to the same point or very, very near. Now, if we take a look at this, a $226 stock, we're thinking about the margin account and the IRA. Well, what I'm going to do is if I said, James, I want to have a higher, okay, that fills on MU. Now, the biggest actually thing is when you take a look at IBM, we're thinking about if the investor says, I am more bullish, I think it could go up more. Now, if they want to have a higher potential profit, probably a long call vertical that they want, okay, or to consider. If they actually said, I'm not really about the profit, I want probability. Well, it's probably about more the short put, okay? Now, what I'm going to do is going to go in the trade tab for just a moment. Let's go to the February for just a moment. And what I'm going to do is I'm going to take a look at the money strike. Now, what I'm going to do is I'm going to buy the 225 strike, okay? The 225 strike, and then sell the 230. Okay. Now, when you look at the open interest there, it's in thousands. We're going to right click right there. We're going to do it in both portfolios. Now, when you look at buying the 225 debit, selling the 230, okay, credit, the debit there to 233. So when I'm thinking about doing a $5 widespread, I'm always thinking without even looking, the debit's probably going to be around 250-ish. 250 max loss, 250-ish max gain, and we're sitting at 233. Go to confirm and send. And when you look at this, the cost of the trade and what the max loss is given the vertical, could we do that right in the margin account? Could we take a $300 loss? We could. Could we do 2 contracts in the IRA? We could. Okay. Now, what I'm going to do is I'm going to go to single account, multiple accounts, and we're going to go 1 in the margin. All I did is clicked on right there. And then in the IRA, going to pick 2. Okay, there it is. What I'm now going to do, now remember, if we do 3 contracts, we're going to be commissioned, okay, for the cost of trade, included commissions, is going to be for 3 contracts. Now, the buying power effect really represents the max loss for the margin and the max loss for the IRA. Could we go 3 contracts in the IRA and still be below the max loss? Yes. In this case, I'll just even go 2. We're going to go ahead and send the order. And on the second trade that we actually did is we picked IBM on a little diagonal breakout with a little push. Okay. Now, the one thing you got to understand is if we start building a portfolio, I want to show you something. Okay. So if we start building a portfolio, this was the day that we picked the portfolio. Started building it again, okay, right there. And what did the market do right after? It started going down. What did the market do after it went down? And it started going back up a little bit, okay? Can your positions be influenced by what the market does? Of course, okay? Now, if we would have put this position, if we would have reset the portfolio down here and the market went up, we would have thought to ourselves, we're a genius, okay? Because I picked the right ones. But that's true to a degree. But you also had the market being a tailwind for your positions, right? So we're also at the influence of what the market does and what the sectors does, what the economic data is. we are buying stocks which are boats on the ocean of the market/economy. Let's not kid ourselves here, right? All right. Now, are there any other questions here? Now, Tiff says, how can you tell if this is breaking a diagonal to the upside or a bear flag? So let me kind of go back to that for just a moment. And so how do we know it's kind of more of a breakout versus a bear flag? Well, the bear flags tend to, and this is a good question, okay? And I hate when people say that because sometimes I don't feel like it's a good question. It's kind of just more they just, oh, that's a good question. That's a good question. Okay. But this is a good question. You see the price drop down. It broke support and it made a lower low. The price goes back up and then it falls back down again. Where do bear flags occur? They tend to occur below moving averages. And they also tend to occur below resistance lines. Okay, so if all of a sudden you get the price to get above the moving averages and maybe even cross over and or break out of the diagonal lines, which we do 2 of them, then that's lessening the chances that it is going to be a bear flag. And it's increasing the likelihood that it is so if you break the resistance, instead of it being a bear flag, you are starting bull flags. Where do bull flags occur? Above moving averages, above support. So wait, summarize this. Where do bear flags occur? Below moving averages. Where do bull flags occur? Above moving averages. Okay, so how would I know if it's bear flag, bull flag? Is the price are above or below the moving averages? It's above. We start thinking about bull flags. Okay, so that's kind of how we'd be thinking about it. Now, let's kind of go back to just real quick, other questions here. So other stocks that we're going to kind of keep an eye on is Lulu is one that, for example, has had a little push. Keep an eye on Lulu. Fade today a little bit off its high, but it's a little elevated here. Sometimes you might get this moving average to try to catch up to it. The other one that we're going to kind of keep an eye on, and I mentioned this yesterday, I'll mention it again, is Google here. Notice that the moving averages are starting to pinch. You see it? Okay, I can't see it because I'm, okay. Those moving averages start to pinch, you can start to get that crossover. For some investors, they like to look and see that cross as more of a confirmation of that upward trend. By the way, not a bad thing to kind of take a look at the weekly chart too, which has already showed the crossover, but that is kind of just showing that intermediate trend / confirmation. Now, I'm out of my time here today, but we did put on 2 to 3 more trades. Those trades were as follows. We did the NVIDIA trade, okay? We also did the MU trade, and we also did as well the IBM trade as well. We also did take a look at kind of setting a conditional exit on Visa, okay? So your homework, I want you to go out and practice cash secured puts with a downside put as protection. Second, I want you to go out and start practicing these long call verticals and short put verticals to try to build a portfolio. Now, could you go out there and practice stocks? Yeah, sure, we have too, okay? But those are the positions that we want to kind of practice here, given the volatility in the marketplace that we've been seeing as of lately. Might not always last, but I want you to go out and practice as we start to reestablish the portfolio, okay? Now, also remember that coming up next, I want to kind of go back to, bring that up. There we go. So coming up next, want to give us a quick reminder that we have the class on getting started with options. Cameron May will be doing that. I want to say thanks to Connie Hill in the chat for answering those questions. And I also tried to actually answer some questions as we went as well. Now remember, this class is not a one-off. We have a class link where you could actually say, can I go back and follow through previous classes that he's done as well? Sure, okay? And Connie has her classes as well, in which you can actually see right here on the right-hand side by simply clicking on her name. You can see her schedule throughout the week or any coach or month, okay, I should say. So I want to say thank you for answering those questions in chat. You are a very live bunch here today. hard to actually kind of keep you in line, but you guys did a great job. And we're great to have Rick here as well. Rick, nice to meet you. Now, also remember that with what we discussed, it was done for example, illustrative purposes only. Always remember it's about what you're willing to risk, okay? And if you don't know what you're willing to risk, it's okay to start small, okay? Now, remember that when we talk about examples, they were just that. And this has been the Investor Master Series. Stay tuned for also Connie and I posting on X our some educational examples and also announcement and any schedule updates. Stay tuned for Cameron May coming up next. Thanks so much. Take care. Bye-bye.